Good morning. A decision has been made. I don't know when and I don't know where, but it was made. The decision to let gold rise towards its natural level, a level that reflects the money supply, a level that reflects the debasement of fiat currencies. At first, this may sound far-fetched, but with a brief explanation, it should make sense. This is a headline from Bloomberg this morning. U.S. gold reserves hit $1 trillion in value after record rally. Unprecedented for Bloomberg to write about gold like this. Since quantitative easing began, the United States government and the Federal Reserve have run what I call a bubble machine. They print money to inflate the assets they want inflated, stocks, bonds, mortgages. But they can't control where all that money flows. Some spills elsewhere, and when it does, they suppress it. They throttle ownership, distort markets, and punish investors. This has been the policy for decades, probably since the Fed began, but most especially since QE. Look at the pattern. When the stock bubble collapsed in 2000, the next outlet was housing. Mortgages were loosened, ownership was pushed, and housing inflated. When housing collapsed, without a substitute bubble, QE arrived, and the bubble became the Fed's balance sheet itself. And that balance sheet is now effectively permanent. They cannot sell the assets that they own. After COVID, commercial real estate collapsed. The government stepped in. BTFP was used to stabilize banks, and then the data center boom. Government doesn't invent new ideas. It latches onto existing ones and accelerates them. The data center boom, while it's real, is being augmented with government intervention like CapEx expenditures to keep the real estate market stable. Now look at Bitcoin. Since 2020, I should say, it has absorbed excess liquidity, marketed as gold 2.0, marketed as an inflation hedge, and deregulated just enough for ETFs. It became the perfect liquidity sponge, they thought. But today, gold has been chosen. Banks that once dismissed it now publish 6,000 and 6,500 targets. JP Morgan and Jefferies. They may be talking their buck, but more likely they've been deputized to tell the public where to go, just as Michael Saylor was told with Bitcoin to influence it. To our ears and eyes, the lid is now off. Gold is once again the permitted hedge against inflation. The US has admitted what the world already knows. Gold is the anchor when fiat weakens. They can track it, they can manage it, and they want liquidity flowing into it. Why? Because the Fed's balance sheet cannot be unwound. Because stablecoins aren't enough, at least not yet, to keep people in treasuries. Because Bitcoin is insufficient so far. And because China and the BRICS have already moved ahead. So the US has raised the roof on gold. We've talked about the floor being raised over the last 3 years. The roof is being raised right now. What comes next, we have contended and are adamant about now, is revaluation. Maybe it's a race with China. Maybe it's just forcing their hand. Either way, the US is steering the system into gold. Call it a bubble if you like. We call it a safety valve. Will gold crash someday? Yes, but not tomorrow. Now is the time to measure gold against M2, against the monetary float, against the capital that has nowhere else to go. Money that goes into gold does not go into the things that you buy, consumed goods. Money that goes into gold is actually an inflation sponge for concerns of everyday items. By that measure, gold isn't 2,000. That's an old support, old resistance. It isn't 5,000. It's well north of 10,000. Consider this. Silver at $47 now trades higher than the value of the gold on the US government's own balance sheet. Silver is priced above official gold price. That screams revaluation. That's a logical, visual bookmark for people to hang their hat on. Gold will be revalued, as Jordan Roy Byrne noted this morning. This is the case for revaluation being made for everyone as we speak. The United States will revalue its gold. I don't know the price, but you can assume that whatever price it is, we'll be trading above it. The question is, how much below that price will we be? So we end as we began. Fiat inflation always eventually comes home. The Austrians are right. The bubble factory needs a safety valve. If we're going to keep the money that's in the assets that we need them in to stay in, the only true place left is gold and silver. Man-made bubbles are temporary. Precious metals are forever. Game on. Thank you. Here are the markets. 10-year yields are down 2 basis points at 415. The dollar is 9,800, up down 17.18. The S&P 500 is up 31, 66.75. The VIX is 1592, up 63. Gold is up $55 off its highs, but well above 3,800, trading 38.15 right now. Silver is 46.61, well off its highs, up 59 cents, traded above $47. We would note, just as a trading comment, at this point, if people are thinking like we are and what we just said to you, and there are people thinking that way, it's time for some people to start selling silver and buying gold again. Expect silver to be much more volatile on its path to being revalued against gold again. Copper up 4 cents, WTI down 79 cents, natural gas unchanged, Bitcoin up 177, and you can see the rest. Palladium is down 5, platinum is up 12, grains are down, corn leading the way lower, and gold silver is up now, but stable between 81 and 84. Last night, Michael Oliver sent out a piece to subscribers, and a large chunk of it was devoted to silver. And quoting him, silver is entering a new price reality. Now, we sent that post out today. That was our breakdown of it, included links. We would suggest you subscribe after you subscribe to GoldFix, but we would suggest you subscribe. Founders, you know what to do. With gold at 4,000, according to our interpretation of MSA's momentum indicator, that puts silver handily above $52 an ounce. But let's continue from there. Michael Oliver's latest MSA analysis signals silver is entering a, quote, new price reality with vertical acceleration underway. Drawing parallels to 1979 and 2010, he outlined scenarios where silver could surge to $100 or even $200 per ounce, outpacing gold in relative performance. This move, framed as structural rather than speculative, positions silver as both a monetary and industrial asset undergoing full repricing. If everybody buys all the gold in the world, then all commodities are going to have to snap to gold in terms of their occurrence in nature. And what's silver's occurrence in nature, whether it be mining or all the gold, silver pulled out of the ground? Tough question, but it's going to be a lot lower. This continues in premium. Silver enters a new price reality, or perhaps it's getting back to its old price reality. Next, related post, we put this up this weekend. All right, so very quickly. JP Morgan flagged 6,000. That was another piece of the puzzle that made us say what we said this morning. Neoliberalism is completely dead. We stand by that. A little bit of corporatism mixed with a little neo-welfareism is where we're going to be headed now. Hartnett, Miner's #1 performer. That story was really a focus on two risks that he has flagged. One of them as if the Fed stops cutting, everything will wash out, and uh, the other one being if liquidity dries up, things can get really crazy. Uh, Bitcoin versus gold, a bank takes a serious look. We think Bitcoin is on its way to being included or seriously considered as a reserve asset. And if you like Bitcoin, yeah, so do I. But there's another reason for it. There ain't enough gold held by European banks to stem their own debasement. They're going to need another asset as a sponge to take their own problems. What could price floors do to silver? $144. That's what we say. CFTC Sunday walkthrough. We didn't have a session, but we did put out a post. UBS reiterates go for gold. And Andrew Maguire's 2 metal revaluation cycle. We comment and break that down for viewers. Must read. This is where the puck's going to be. China is going after the BIS now. This has been a very popular post, and we stand by it. We think it's tied to the HQLA. It's tied to the repo. That may or may not happen, but we think all these things that are happening are shots across the Western bow, and it's just going to move us into extolling the virtues of gold again. That's where we are. Coming soon, chat. The chat has been, obviously very busy and a little bit unwieldy for me as a solo practitioner. So I'm going to create a couple sub chats today with a fresh new one, and I'll seed them with concepts. So options, trading, macro, other markets fundamentals. And this way people can find each other in the topics that they want better. This week is non-farms payroll. And I want to mention this very carefully. One of the things Hartnett said was he said inflation as a risk is back on the table, meaning, according to his data, the Fed doesn't really need to cut much more than one more time. So if inflation comes in hot, or if the economy comes in okay, meaning the jobs number, then there's a good chance he may come out and say, we're not going to cut so much. So that's the rug pull under stocks and under gold, ostensibly as well, if that were to happen. I'm not so sure that'll happen, and neither is he, but it's something you have to be aware of now. So if you're a macro trader, you care about this Friday, which is the unemployment report. The unemployment report comes in really weak, then the heck with inflation. They're just going to keep cutting, right? If unemployment comes in strong, then you have to worry about inflation being back on the Fed's radar, at least for a couple weeks. I'm Vince. We're going to be sending out our cover of the Bloomberg story as well later on today. Have a great day.